Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement, presented by Chris McIntire, Northwest Ohio's retirement planning resource.
And welcome into the program, your game plan for retirement with Northwestern Ohio's resource for a common sense approach to planning. For information on our financial investment and retirement future, he is Chris McIntire, president and founder of McIntire Retirement Services. Always a pleasure, Chris. We appreciate the time and the insight and information on the financial world and what we need to be doing or thinking about and paying attention to with our money. And today, no different. You've brought along a great report, this resource of the 9 critical risks to address for a more confident retirement. Welcome back in, Chris.
Thanks, Peter. Good to be with you. Yeah, and there's, many different risks that we can talk about here today. We've broken it down into 9, and there's probably some subcategories underneath even, each of those main topics. But, we'll highlight some of those and, kind of delve down into the details here over the next 30 minutes and make a good show out of it.
Yeah, well, I think that it's important to highlight these because I noticed that several of these are things that we do not encounter during our working career. They are actually specific to retirement. So while we are working, while we're earning that paycheck, we may not really hear about these or certainly not have a large impact to our financial well-being and security. But in retirement, they become major issues. So we want to educate everyone on these factors that can impact your retirement. And ladies and gentlemen, if you'd like the list of the 9 critical risks to go over on your own, or if you would like to sit down with an experienced, qualified professional, Chris McIntire at McIntire Retirement Services, simply pick up the phone, give a call, 800-868-1194. That's 800-868-1194, 800-868-1194. And just to comment on that last issue, Chris, when you do transition into retirement, there are a number of factors that are distinctly different than your working career. And it's pretty important to identify those.
Yeah, no question about it. And I think the performance of the stock and the bond markets in 2022, kind of are going to bring some of these right to the forefront. So, for example, if you just retired at the beginning of 2022 or even halfway through it, you saw your bond values go down, you saw your stock values go down. And if you begin to take money out of your portfolio there, you suffered the first risk we're going to talk about. It's called sequence risk. I just retired, the market's going down, so the sequence of the returns of the market will have an impact years down the road as to what piece, how much of your pie is left over. And, it can be quite emotional and nerve-wracking when the first year of your retirement in 2022, for example, bonds are down 15% and, the general stock market like the S&P 500 was down 20, and you're pulling out 4%. That's a tough one to swallow. So sequence risk can certainly be a gut check. So some of these risks we're talking about are, probably closer to the surface than some of the other ones.
Yeah. And Chris, even for those that may have retired a year or two earlier, right? Like a lot of people decided in the midst of COVID that they were very happy and comfortable working from home or being at home more and then decided to retire or unfortunately got that furlough or notice from the company that services were no longer needed. A lot of retirees and retirements happened and occurred during the midst of COVID up for a couple years, but this is a real jolt to the system when we see a year like 2022 early on in retirement. It doesn't have to be the very first year. Any year in the early part of retirement is encountering sequence risk, correct?
Yeah, it absolutely is. And, when we do our educational events, we show folks, look, here's somebody that retired in 1999 versus somebody that retired in 2009. And, show the impact of those different sequences there, if you will, because then we had 2000, 2001, 2002. So the sequence of the returns on that individual person's retirement was remarkably different than, say, somebody that retired in 1996 versus 1999, and they had exceptional years of growth before the market declined versus I just retired, I'm pulling money out, and we got hit pretty hard. So it's a remarkable, sometimes it's the luck of the draw, but I think the point we want to make here is this is why you also use some alternative plans or a plan B, if you will, just in case something happens to the money that's directly invested into the stock and bond markets and the performance is disappointing or not sustaining what you need to pull out, that you've got an alternative in place. And that's what planning does. And that's what we help folks do.
Yeah, a very different market, a very different experience, a very different environment, Chris, in those 2 decades. From 99 to 09, the market essentially flat, if not down a little bit over that decade, whereas the following decade, 09 to 2019, a fantastic run in the market. It's just, we don't know which the next decade is going to be more like, right? We don't know what the future of the market holds. Is it going to be flat, choppy, or are we going to see a rising market? I do feel like a lot of investors have some concerns right now, though. Are you hearing about those?
Oh, yeah. And, probably the biggest one we hear right now around market volatility, because that's another risk. Sequence risk has to deal with when you're pulling money out. Market volatility is just the general conditions of the market. Is, what's happening to the US dollar? Is the dollar getting weaker, which would lead to a rise in inflation because it would take more dollars to buy foreign goods and whatnot, if you will. And a lot of that, plays off of, probably the geopolitical forces out there, and probably in particular with China trying to get other countries to trade their oil in China's currency versus US dollars. So the weakening of the currency could certainly lead to, continued market declines potentially. So that is a concern for a lot of folks right now. And, Peter, you and I have been doing this long enough. I've got more gray hair than you do, but
just by a few.
Yeah, you'll catch me here before too long. But there are times when market performance, is disappointing, and that's why when you invest, you have to have that longer term time frame, especially investing in stocks. Bonds will typically give you that cushion. 2022 was a different example because they raised interest rates faster than any other time in history to put inflation back into the bottle. But it just goes to show you that, things can happen, and things can happen quickly, and the markets can turn and become positive just as quickly as well. So that's why you have to stay in it to win it.
Yeah. And again, these 9 critical risks listed and identified on this report, ladies and gentlemen, all are important for you to identify and address for a more confident retirement. So if you would like the list, again, to go over on your own time, or if you would like to sit down and really look at your plan to make sure that you have identified and addressed each item on this list, pick up the phone, give Chris McIntire and McIntire Retirement Services a call, 800-868-1194. That's 800-868-1194. And Chris, while you have itemized each one of these risks, I also am beginning to pick up on the fact that many of them are interconnected, because as we are explaining one, we're also hitting on a couple others there. Yes, sequence risk is one, but you mentioned also market volatility and did have some differentiation there. The market volatility can happen really at any time. No one likes it that much, but when we are withdrawing money, that compounds on the difficulty of market volatility. And we have to figure out yet another risk on here. What is an appropriate withdrawal rate risk? Is that settled science at this point in time? Have we arrived at any kind of conclusion on what is a safe or a reasonable rate to withdraw and create income from our portfolio in retirement?
And Peter, that's a story that's been told for a long time here. Is, the 4% rule is what I think Charlie Bengen, a financial planner in California, created that theory in 1994. And it was that you should be able to create a portfolio and pull out 4%, adjust it for inflation over your life expectancy, and should, I'll use the word should because there's no guarantee there, come out okay. And again, that's where a sequence of return risk would come into play, the market volatility, and then the withdrawal rate risk. So, if we turn the clock back about 2 years ago, interest rates were zero. We couldn't go in and put $1 million in a CD and expect to live off of the interest. Where today we could probably walk into any bank and find 4 to 5.25% in a CD. All right. And if you can find 5%, you put $1 million in there, it means you can withdraw 5% of that piece and still maintain your principal. Now, it won't have that inflation adjustment. That's the other side. You could create, stocks that pay dividends, stocks that grow, and even bonds that pay interest. Real estate is another alternative as well, that, you have the ability to, purchase big apartment buildings or pieces of them through either a REIT, an exchange traded fund, or some sort of income-based mutual fund that deals a lot with the real estate markets. And there you would get some of the income that people are paying to rent apartments or rent manufacturing facilities, warehousing, that type of thing, Peter.
And Chris, you have some real estate components available as part of your client portfolios as well, correct?
Absolutely. Yep. And it's, and it had performed very well when in the year 2020, 2021, and even 2022. 2023, the interest rate side is hitting the real estate market, as fast as rates went up. People can look at other alternatives. So there's always a give and take out there, but, it does make up a component for an income-based plan. Typically is going to have some type of real estate holding in there to generate income.
You've mentioned, as we've talked about, the withdrawal rate, the interest rate environment impacting this as well. Is that one of the problems that we were having with generating a cash flow in retirement? I know that the low interest rates were good for stimulating the overall economy, but for a retiree, those low interest rates created some issues, it sounds like, in generating a reasonable cash flow rate.
Yeah, it sure does, because the only way to create more money out of what you've got in a very low interest rate environment is by the value of stocks growing or the dividend payouts, right? If interest rates are low, that means bond interest rates are low, CD interest rates are low, and the only way to create more cash flow, more growth is stock values going up or dividends increasing. And, both of those are good, but in a rising interest rate environment like we are at now, is that going to impact the long-term growth of the stock market when I can walk across the street and put money in an FDIC insured CD, for example, or a 4 or 5 year multi-year guarantee fixed annuity and make a decent rate of return and take zero market risk? So if less money is going into stocks, that means that growth is going to slow down a little bit, from the price of them going up, because it's a law of supply and demand where we have more attraction into the bond market, kind of that traditional CD and fixed rate income buckets, if you will.
Well, again, we've got to determine that cash flow rate, and it doesn't have to be a limiting factor, but keep it between the guardrails, so to speak, Chris, in trying to formulate a plan in the early years of retirement so that we don't overspend and outspend our ability to enjoy the later years of retirement or have a reasonable quality of life and income, correct?
Correct. And that would, kind of lead us into the inflation risk side of things. I don't think many of us were too concerned about inflation for the last 15 years until
for a long time. You're right.
Yeah. Until this year, obviously 2022 and 2023, I should say. And, it's probably going to continue for a while. I just read this morning on the Bloomberg website that the inflation rate in the United Kingdom, which is Britain and Scotland and Northern Ireland, is still at 10%. And, imagine your food going up by 10% a year. I mean, that's a very impactful on the retirees that are more on a fixed income level, obviously, is where you're going to see the greatest impact. And here in the United States, guess where the largest part of our population segment is, or where it is trending very rapidly, is in that retiree side of things, people over the age of 65, where inflation has the greatest threat to their, way of living.
Not only is it more impactful on retirees, Chris, but I heard what I felt was kind of a light bulb moment comment one time, where the hockey stick graph that shows the time value of money and how compounding interest works and how things really go up over time. Yes, that works when you're talking about growth on your money, but it is the same effect with inflation. If we've got a few years of this higher inflation, that is really going to accelerate that hockey stick pretty significantly.
It actually is. And folks, I will tell you, Peter and I are very big hockey fans in the playoffs here. So hence the hockey stick reference. But if you were to lay a hockey stick with the heel of the stick on the ice, you would see how sharply, about a 45-degree angle, basically, in the run up in the price of stocks is what his reference was. But if you put that with inflation, the run up of that cost of living there, that's a significant impact. If inflation stays at 6% in 12 years, you'll need twice as much income to buy the same things you're buying today. And not many people have that cushion in their overall nest egg in the United States.
Well, once again, we are talking with Chris McIntire. He's got this great report of the 9 critical risks to plan for a more confident retirement. If you would like this list of these 9 risks to go over on your own time to review and to reflect on how you in your situation and your planning have addressed each and every one, and have you addressed each and every one, or if you would like to sit down and review your plan, get your game plan for retirement put together with an experienced, qualified professional, the team at McIntire Retirement Services, Chris McIntire, make those opportunities available for you, to you, just for being a listener to the program. Pick up the phone and give a call, 800-868-1194, 800-868-1194, 800-868-1194. Chris, as you were talking about withdrawal rate risk there, kind of a realization, and I guess it's just simple math, but I hadn't really yet thought about it before. If we are taking a 4% cash flow rate from our portfolio, that means that 5 years into retirement, we've withdrawn 1/5 of our starting retirement balance. That just seems like an awful lot of that retirement nest egg in a relatively short amount of time, when we are seeing retirements last for 30 or more years these days.
You're exactly right. And, imagine you get a 20% correction on your portfolio.
On top of that, yeah.
Yep, on top of that. So it can be very, very impactful. And, like Peter said, hey, if you're looking at 30 years, we've got a longevity risk factor here that we need to hedge as well. And obviously we can do that, by, adding different types of investment pieces out there that, can provide that lifetime income with a contractual guarantee. So, there are ways to hedge all of these risks. We're not here saying, hey, there's so many risks out there, don't, bury your head in the sand. It's like, identify what they are, and then what are the possible solutions. And, if you've got enough flexibility in your portfolio, you may have 2 or 3 different solutions for some of these different types of risk. And, that makes all the sense in the world, right?
Well, again, Chris, you've connected a few of these different risks. They're more like a spider web. These are not one-off things that you can identify and address individually. You really need to look at the comprehensive list of risks, talk them through, see how they are connected, and then plan for them. Because longevity, it's something that we hope for. It's something that we want. And then it's something that turns around and compounds on all of these other risks. It really multiplies them.
It certainly does. So if you think of longevity risk, okay, well, the longer you have to live, the more different types of risks that can come up in play. And one of those could be, you suffer a stroke or cognitive issues, and you might need to go into some sort of care facility, assisted living, long-term care, the full-blown nursing home, hospice, all of those things that can be incredibly costly. Okay? And then you pass away, and you may have a spouse remaining that all of a sudden, well, heck, we spent, 3/4 of our nest egg taking care of one of the spouses. That spouse has passed away, and now we've got somebody else that may be in fairly good health. It happens all the time. So again, leveraging those types of risks that, the stock market can fall by 20, 30%, as we've all seen in our investment lifetime. And then you can also spend a significant amount of time in a nursing home that could be, $6,000 to $10,000 a month, depending where you're at and the level of care that you need. And, $8,000 a month in the nursing home's $100,000 a year. And are you pulling that from an IRA that may have some taxable consequences as well?
Yep. And so you've hit on a couple more on the list here. Healthcare costs, long-term care, a critical risk that we must address. Chris, those prices are not getting any cheaper. In fact, inflation, well, one of the things that inflates the quickest and even above other average inflation rates are the cost of that healthcare, and then taxation on top of that. I mean, most of Americans and retirees' money is in yet to be tax deferred accounts. It's something we're absolutely going to have to account for.
Yeah, no question about it. And, we hear the politicians from time to time talk about, hey, we're going to raise some taxes here and we're only going to target the wealthy. And, I think when they raise taxes, it catches a little bit of everybody, just like when they cut taxes, catches a little bit of everybody. So, things can change the way they tax your Social Security benefits, right? That's not a upper income issue. That's a lower income issue. The way they make you take money out of IRAs at different times throughout your life. Now it's age 73, and then when you pass away, how those IRAs have to be distributed to your children. So the legislative issues that we deal with can change in a heartbeat, as well as powers that be change in the halls of Congress, if you will. And I suppose you could even say at the state level as well. The state of Ohio is fairly tax friendly, but some people will retire and maybe move to a Tennessee or a Florida where they don't have any state income tax to save money. So, there is a lot of legislative issues to pay attention to also.
And it's not just on those $400,000 or more incomes, Chris. As we've talked about, the current laws on the books sunset and expire in 2025 and 2026. The 12% bracket, one of our lowest tax rates and brackets, increases to 15%. And by the way, that is not a 3% tax increase. That is a 25% higher tax bill on those dollars, right, Chris?
Yeah, exactly. Going from 12 to 15 is a 20, like Peter said, 20-some% increase. So if you think about it, if you had $50,000 being taxed at 12 to $50,000 being taxed at 15, that 3% more on 50,000, that's another $1,500.
Yeah, we have to factor these things in. We have to understand these 9 critical risks. And again, ladies and gentlemen, if you would like this list, pick up the phone, give a call. Chris McIntire makes it available. If you would like to sit down and review the details of your plan to make sure that you have identified these and planned for them specifically, pick up the phone, give a call, 800-868-1194. That's 800-868-1194, 800-868-1194. Chris, the outcome of our retirement is really contingent and reliant on how we have identified and addressed and handled these risks.
Yeah, no question about it. I mean, we insure our cars for an accident happening. We insure our houses in case they get burned down. We insure our general health with Medicare or private health insurance, depending on what your age is. Why not insure your income? Why not insure, the nursing home side of things, the catastrophic things that can happen to your nest egg that you've built to enjoy a retirement and provide yourself some peace of mind. It's going to cost you some pennies to buy some dollars. That's probably a good way of looking at it. And then to ensure the protection for your spouse, for those of you that are married listening to the show today, when something happens, what is that impact? Are you losing a Social Security benefit? Is a pension benefit being cut at a time of high inflation? And how can you hedge that risk? And that's what we help people do all day, every day.
Chris, a lot of people don't realize that spousal income situation occurs, that there is some dependency there, and streams of income do disappear. The spouse may be left with a very different financial and income situation after we pass away.
Yeah, no question about it. That's a big one. People think, aren't always sure what Social Security they'll get. If they were a teacher here in the state of Ohio, they may not get any of their spouse's remaining Social Security because we have what's called the government pension offset. So it kind of depends what they did for a living. A lot of variables out there. And, that's where you can hedge a term insurance policy, for example, just in case something happened early in retirement that, all right, I passed away. My wife's not going to get into my Social Security benefit, but I did buy a $200,000 term policy just in case that happened,
Chris, on this list, if I'm having to kind of step back and look at them, I think that in taxation is probably the one where there's the biggest opportunity right now that we can control it and we can minimize it and we can reduce this risk as well as the bill that we'll ultimately have to pay. And yet I think it's the one that is probably overlooked as much or maybe more than any of these other risks.
Yeah, you're absolutely right, Peter. Not to minimize any of these other risks that we have talked about here today, but protecting that spousal income from all of the other risks that we've talked about here today is probably paramount for most of the married folks listening out there today. Yeah. And husbands, you should be nodding your head yes, so your wives can see that, yeah, I'm listening today.
Yeah. Well, and Chris, a lot of the decisions I make financially are for the protection of my loved ones and my family. My wife, my son, they're pretty important. I feel like, I could have a much simpler life if I didn't want to provide for them. And I want to continue to be able to do that. So again, all of these risks compound and grow not only on each other, but over time. We've got to face them. We've got to address them. And as with most things in planning, Chris, the earlier, the better, right?
Yeah, no question about it. It's usually cheaper. It's easier. There are more options the earlier that you do, some of your risk management, if you will.
Well, again, ladies and gentlemen, if you would like this list of the 9 critical risks to address for a more confident retirement, pick up the phone, give McIntire Retirement Services a call. You can reach them at 800-868-1194 and just request the 9 critical risks list. You can also go online, McIntireRetirementServices.com, and just hit the connect or contact button there and request the list there. Offices conveniently located throughout Northwestern Ohio, and they do offer the opportunity for in-person or virtual appointments. And if you would like to get your game plan for retirement put together or just review and update and double check your current plan to make sure that you've got an answer for how you will address these 9 critical risks, that's the true value of the program and the resource there at McIntire Retirement Services, Chris McIntire, to help you plan to get your game plan for retirement put together. 800-868-1194, the number to call, 800-868-1194, 800-868-1194. Chris, always a pleasure. We appreciate the time, always good food for thought and information, but we got to take action on this information in order to gain from it, correct?
No question about it. Yep. The best answer is, it could be different for many of the listeners out here today. So appreciate you listening today, folks. Everybody have a nice weekend out there and stay safe.
Always a great time talking with Chris McIntire. He's looking forward to hearing from you soon. If you'd like the list, again, pick up the phone, give a call. If you'd like to review your plan, get your game plan for retirement put together, pick up the phone, give Chris McIntire, McIntire Retirement Services a call, 800-868-1194, 800-868-1194. Looking to help in any way they can. Looking forward to hearing from you soon. Take care.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.